10 years ago when I started investing, one common popular piece of advice was to focus on dividend stocks for passive income. It's like making money in your sleep. But if I followed that advice, I would be missing out on tens of thousands of dollars in my retirement portfolio already. And unfortunately, that popular advice is still misunderstood today. In this video, I'm going over who actually does benefit from dividends, who does not benefit, and what I like to do instead. To most investors, and especially beginner investors, dividend investing sounds very appealing. It's got a lot of things going for it. I never have to worry about selling my shares for cash because I'm always getting paid dividends. I can look for companies that have growing dividends, so I'm always getting a raise. To find good valuations, I can look for a company where its dividend yield is higher than normal, and then I can invest at a good price. And then one day, my dividends are going to exceed my expenses, and then I will reach financial independence. The dividend playbook is very straightforward, and it's very nice. That's why a lot of people love the strategy. When a dividend investor is looking at an individual company to invest in, they're looking for companies that have historically never cut or reduced their dividend, and it has a relatively high yield at that time. The way dividend yield works is a company announces what its dividend is, that's what it's going to be, and then if the company's share price goes up, then the dividend yield goes down, and if the share price goes down, then the yield goes up. So I can find companies at a decent valuation if I wait for their dividend yield to go higher. Essentially, as a dividend investor, you end up with a bunch of mature, profitable companies at a decent value. And that's really great, but you're also missing out on a few different types of company. You're not really investing in many small companies. You're not investing in very many volatile companies or high growth companies. Now, for some investors, that's completely fine. There's three things that dividends are actually really good for. When you're at the end of your investing journey and you're ready to start pulling money out of your portfolio, it's nice to get paid directly out by the profits of the company. Because if the stock market crashes and share prices get pushed way too low, you're not forced to sell as many shares at the bottom when you need cash. You're getting paid out dividends from the company's profits, assuming the profits haven't been damaged. The next thing that's really nice is volatility. Dividend paying companies are generally less volatile than growth companies, especially if you focused on mature, stable, strong companies with a strong history of posting just constant dividends. You're not going to get hit with a big down year as badly at the beginning of your retirement. Sequence of return risk is one of the biggest fears for people who are entering their retirement, because if you have a really tough year very early on, like in year 1, 2, or 3, and your portfolio dips a whole lot and you're forced to sell, it can completely ruin the rest of your retirement. But dividend yielding companies are less likely to suffer from sequence of return risks. And then finally, the dividend investor benefits from just being able to adhere to their strategy a lot easier. One of the biggest problems with investors is that they panic during a market downturn and they sell their shares at the worst time. And then they're too scared to get back in until the stock market has recovered, sometimes back higher than where they sold out at. So they end up selling low and buying high, which obviously is one of the worst things you can do. So dividend investors a lot of times will have a much easier time adhering to their strategy. Time in the market beats timing the market. However, if you are in the accumulation phase of your investing, where you're not pulling money out, you're constantly putting money in, and you've got the stomach to not panic and sell your investments if the market has a downturn, and you're prepared to buy instead of sell, then dividend investing is probably not the best path for you. The first big problem has to do with why a company decides to pay dividends in the first place. In general, there are two primary ways that a company can put cash in the owner's hands, either through dividends, which is just directly paying out cash from the profits, or through capital gains. If a company appreciates in value, the owners can sell a few shares and get cash out of the company in that way. So in some cases, when a company is growing very rapidly, they can actually put more money in the shareholders' hands by reinvesting all of their cash into growth instead of paying out some of that extra cash to shareholders. And a really great example of this is NVIDIA. Just in the last few years, NVIDIA has been doubling their revenue year over year because they have been investing in their own growth. If instead of that investment, they were just paying out all of their cash to shareholders and they missed out on that growth opportunity, then we would receive way less total cash in our hands from the dividends than we can today from the capital gains. Now, there are some downsides with this strategy. If a company is investing aggressively and heavily in its own growth, and then that growth doesn't pan out, all of that cash is kind of lost to investors. Whereas if they would have just paid it out directly to the shareholders, then the shareholders could invest it elsewhere and still receive some benefit. Also, there's going to be higher volatility when companies are aggressively investing in their own growth because investors in the market can't exactly tell how much growth there's going to be. So 1 month, growth might look really plausible and the share price shoots up. And then the next month, maybe investors start having a second thoughts and the share price drops back down. So there's a lot more unknown, so a lot more volatility. There's also more risk, but in exchange for the risk and the volatility, you have higher expected returns with a lot of these very aggressive growth companies. 5 years ago, if I was focusing only on dividend paying companies, then I would miss out on the 7 best investments of the last 5 years. These are the 7 largest companies in the stock market today: Google, Broadcom, Meta, Amazon, Apple, Microsoft, Nvidia. These companies, none of them have high dividends or are known for their dividends. And when I go through these companies over the last 5 years, Apple increased by 130%. Microsoft, 160%. Nvidia, 1,350%. Meta, 208%. Broadcom, 859%. Google, 250%. It's amazing how much return you're missing out on if you are only focusing on dividend paying stocks. The second big problem with focusing on dividends is tax problems. Believe it or not, selling shares is actually better at creating a dividend than receiving an actual dividend. When you're selling a share, you only pay long-term capital gains tax on the profit of that share. You're not paying taxes on the whole share. For example, if I have 100 shares of stock worth $100, so now I have a total of $10,000 in this stock. If that stock grows by 20%, now all my shares are worth $120 and I have $12,000 in stock. If I receive a 1% dividend, then I'm going to get $120 in cash, and I would have to pay long-term capital gains on all $120. Now, the result of that would be the company would lose 1% in value because it's dropping out 1% of its value in cash. The shares would now be worth $118.80, and then I have 100 shares still, so I would have $11,800 in in shares plus the cash that I got from the dividend. Now, on the flip side, if instead I just sold one of my shares of stock, that would be the same thing as getting a 1% dividend because I'm selling 1% of my shares. The result would be I would get $120 in cash, but I would only have $20 in capital gains. I would only have to pay long-term capital gains on $20. The result is I only pay $4 in tax if my tax bracket is the 20% bracket versus $24 in tax if I received a dividend. So in this case, it's actually 6 times more expensive. I'm paying 6 times more taxes if I am receiving a dividend. Now, as I get more and more capital gains, the two situations will start to balance out. Dividends will get a little bit closer to capital gains, but for the most part, capital gains are going to be better tax treatment on selling shares than what I get for dividends. And then if I'm in the accumulation phase of my portfolio, I don't even need the dividends and I don't need to sell shares either. I don't have to pay taxes at all. Now, if I'm receiving dividends as I go throughout 30 years of investing, those small little bits of taxes are going to start to add up. For instance, if I have 2 holdings and one holding is going to make just 0.5% less over a 30-year period, the result is losing hundreds of thousands of dollars. Here is an investment return calculator where over 30 years at a 10% return, I'm putting $1,000 every month into my portfolio and I end up with $2,080,000. Now, the other example here is if I invest for 30 years once again, but now I'm only getting 9.5% returns. So there's just a 0.5% drag on my portfolio. I'm still putting in $1,000 a month, but now I end up with $1,880,000. That is a $200,000 difference for just a small drag on the portfolio. Now, it's hard to say what your actual tax drag will be because it depends on so many factors, but this just goes to show that over a long period of time, only a small difference can add up to a huge amount after decades of investing. The third problem with focusing on dividend stocks is you suffer in terms of diversification. When you are only focusing on dividends, you are missing out on certain types of companies. You're missing out on small companies, you're missing out on growth companies, you're missing out on highly volatile companies. We've already seen how some of those companies can make really, really strong returns, but you're also missing out on certain sectors of the economy. This chart shows the average dividend yield for each sector of the economy, and we can see that the three highest in terms of dividend yield are real estate, energy, and utilities, whereas the three lowest are information technology, communication services, and consumer discretionary. Now, there is also a chart that shows the average return over the last, this is the last 15 years by sector. And wouldn't you know that the two best in terms of average return are number one, information technology, and number two, consumer discretionary. Two sectors that have the lowest dividend yield that you might miss out on. Some of the sectors that have the lowest return over the last 15 years are utilities at 10%, real estate at 10%, and then the absolute worst is energy at 6%. And these are the three that have the highest dividend yield. So your portfolio is going to be more tilted toward these lower returning sectors, at least historically, if you're focusing on dividends. It is so important to diversify across all sectors, because if one sector does really well and you're invested in it with everything, you're going to benefit from that. And then if you're focusing too much on another sector and then it underperforms, then your portfolio is going to be drugged down as a result. By investing across all sectors, we reduce the risk of our portfolio without hurting the projected returns. So if we accept the idea that focusing on dividend stocks can hurt us, especially if we are investing in our accumulation phase, what do we do? What is the best path forward? Well, first and foremost, the most important thing is we have to pick a strategy that we can adhere to. It doesn't matter if one strategy is technically better on paper, but you fold under the pressure when the market crashes and you can't handle the amount that you're seeing your portfolio drop, or if it's causing you too much stress and it's just not worth it to you. It doesn't matter. All of those human factors will hold you back even if one strategy is better on paper. So number one, we have to make sure that our strategy is achievable. Also, if I don't have the time to research companies sufficiently to make educated decisions on picking individual companies, then it is much safer, much more reliable for me to invest in index funds and ETFs. Baskets of stocks where I can put $100 in a single share of an ETF and it will automatically spread my money across hundreds of companies. If I'm investing in ETFs, the most important thing is to make sure that I'm investing in diversified ETFs with incredibly low cost expense ratios. The expense ratio is a percentage that tells you how much money you pay the managers of the fund every year to manage it. Now, expense ratios can vary by quite a bit. I typically look for expense ratios that are under 0.1%, but if you're not careful and you pick an actively managed fund, expense ratios can be as high as 1%. And we already saw how much of a difference 0.5% can make. 1% makes a huge difference. The portfolio that returns 10% per year for 30 years gets us up to just over 2 million. And if we instead have a return of 9%, that would be the same exact fund, but with a 1% expense ratio. Now we're only ending up with 1,700,000. So now that's over a $300,000 hit just because we have an expense ratio of 1%. Now, if we compare that to an expense ratio of 0.1%, now we're ending up with 2,039,000. So we're only sacrificing 40K as opposed to 300K. If I do have the stomach to invest through market downturns, and I do have the time to spend to analyze companies and do my research and make educated decisions on investing in individual stocks, then I am simply ignoring the dividend. That doesn't mean I'm not factoring it in to my total return, but it doesn't matter if my total return comes from a company with a dividend or without a dividend. The dividend is just one way that a company can put cash in your hand, but it's not the most important question. The only question remaining is, how do I know how much cash a company is going to make for me? Check out the next video.